So, thank you very much for the invite. It's wonderful to be here. Slightly alarmed at being on a platform with a coffin. So, if I'm not invigorating enough, does that where the speaker actually ends up, I wonder. Anyway, Oxfam, as you probably know, global international development agency, both does humanitarian emergency response, does long-term development, does in both fields advocacy around both of those issues. And the idea for an investment fund principally came out of two things, really. One, if you go into the communities in which we work, and many of you are familiar with and work in also, and you ask people, what do you really, really want? And they say, we'd like a job. And they want a job which is in the semi-formal or formal sector. So this is not simply income generation, it is actually employment. And one of the generators of employment is small enterprise. And by small enterprise, for purposes of our fund, we mean enterprises employing between 5 and 100 people. And if you look at Africa, 90% of those enterprises don't have access to capital and financial services. So this is above the microfinance income generation space, and it's below the commercial banking or investment space on the whole. And it's been given a suitable title, which is called the missing middle. So it's a missing middle of small enterprise finance. So since Oxfam is not an investor, we thought we better have a partner to help us establish the fund. So we went out to market and we looked at a whole range of institutions who are engaged or involved in what has come to be known the impact or the social investment space. And we ended up with a boutique outfit, if that's the right way of describing it, called Symbiotics, who are based in Geneva, in Switzerland. They are one of the market leaders in investment in microfinance, and they recognized that there was a definite transformational change in the market towards a focus on small enterprise. And so, and there was a very strong value fit. Symbiotics is owned by its staff. It has a very solid reputation in assessing not only institutions from their financial ability, but also their environmental and social responsibility. And then there is a slightly, perhaps less values fit with the City of London Corporation, but it was a very interesting conversation. And all three are the initial investors into the fund. So the City of London Corporation, which is the local authority for the City of London, has just launched a social investment fund. It has, I think, £30 million allocated to it, and we were, SEIIF was the first investment. Ooh. So, the vision of the fund is to advance small enterprise financing in developing countries in a manner which is consistent with our mission to eliminate poverty. This group of cheerful beekeepers, I actually think, are in Ethiopia, which is one of our projects. So, and it was designed to give people, investors, an opportunity for investing against two things. One, we hoped financial rigor, but also to develop an impact narrative that was credible and made sense. When we went to market to test out this idea for a fund, we were told that one of the key drivers that is, or key obstacles to the development of social finance is the credibility of our narrative. Can you tell a meaningful story about what is actually happening to the money that you are investing? And can you come up with ways of measuring that which were both cost-effective, so they weren't a huge disruption of the business, but also told a credible story? So we went out and we wanted to say we were going to invest in job creation. We were going to invest particularly in women's opportunities and empowerment, and that we were going to invest a significant proportion of the fund around the themes of food and sustainable agriculture. And all of which are important, and of course, probably doesn't require telling this audience that the focus on women is absolutely critical to development outcomes. As we all know, women are much more sensible when it comes to spending their increased assets and income in the developing world. It's always nice telling that to an audience which is predominantly full of men, but simply true. You know, women spend it on their children, they spend it on education, they spend it on health. Men spend it mostly on booze and gambling. Now, that's, of course, a stereotype, of course, but actually it keeps repeating. If you look at the development space, it's very important to empower women. So what's the strategy of the fund? So here we have some key statistics, many of which will be very familiar. 80% of the world's population lives on less than $10 a day. 70% of the world's growth is actually in emerging and developing economies at the moment. Micro, small, and medium enterprises are 95% of the private sector, and they generate over just about half of the employment that we see. And 2/3 of those SMEs are also in emerging and developing countries, and they significantly, depending on the region, don't have access to capital. Africa, it's 90%. East Asia, which we think have more developed markets, it's still half. 50% small enterprises in East Asia don't have access to capital. So there's the space we wanted to try and occupy. And clearly that access to capital can be a catalyst to poverty reduction. So we wanted to develop small enterprises, so we wanted to go to the lowest end of this space, the 5 to 100 employee space, but above microfinance. And again, we want to focus on key themes around women, food, and job creation. And so, what did we want to invest in? Well, so we went and looked at the investment universe, and we looked at about 250 funds. They're structured as funds. We looked at microfinance institutions that are developing small enterprise portfolios. So they're moving up a notch in their space. We were interested in leasing companies and credit cooperatives, and even NGOs might possibly be investable. Who knows? We shall see. But what we wanted to try and do with this fund, what we're trying to do with this fund, is to begin to help develop an infrastructure for financing enterprises at this scale. So can we find a range of different models of doing this which we can invest in credibly? So, and this is again what I've said. This is a piece about why you should invest in this space, because we're trying to create a dual narrative here. We're trying to say to investors, yes, you can have reasonable returns in this space with relatively low volatility, particularly if you're investing in financial intermediaries you're investing debt into those intermediaries, they're investing debt into their small enterprises. If you look at microfinance as a kind of benchmark, if you'd invested in microfinance 10 years ago, you'd have got, on average, between 4 and 5% on an annual return basis with very little volatility, perhaps about 1.5%. So actually, even through 2008, 2009, extremely volatile period, as we all know, and still volatile, microfinance investments had that level of return and that level of relatively low volatility. So from a finance point of view, we think it makes sense. This is all rather technical, but it's all about the ways in which we're going to invest. And basically, the fund will be 80% debt and 20% equity. So most of the fund will be lent to financial intermediaries to on-lend to small enterprises. Some will be invested into funds who may themselves then invest into enterprises at the larger end of that fund. I'll skip that because that's all rather technical. But here's a much more interesting bit. So how are we going to know that this money actually works? So, and it works, well, we know it works from a financial point of view because people will repay their investment, hopefully, but from an impact and social point of view. So what we decided to do was to try and create a set of indicators, not on our own, because that would be absurd for us to create our own indicators. So we went to IRIS. So IRIS is a set of indicators that were developed by GIN. So GIN is the Global Impact Investing Network. It was founded about 2.5 years ago in the US with a sort of Gates, Rockefeller Foundation, Clinton Initiative, JP Morgan, to try and instill into this notion of social investment some rigor about what actually was a social investment and could you measure it, and to act as a network both of practitioners and advocates for extending this space and developing, hopefully in the fullness of time, social investment as an asset class in its own right. So IRIS is the subset that looks at small enterprises. So we took IRIS and we took parts of IRIS and we developed a set of indicators around these issues. So we will know from our investors, if it all works out, that how are their small enterprises growing in terms of their outputs, in terms of their customers, in terms of their suppliers? Will we know what they're creating in terms of jobs? And are those jobs actually just people moving from one small enterprise to another, or are they people actually moving from the informal into the formal economy? We will know whether they're women and men. We will know whether they're part-time or full-time. We will know whether women and men are actually being paid the same for the same activity. And we'll even know, I think, all being well, whether the workplace has actually thought about what are the barriers for women actually being employed. And we'll do that, hopefully, in a way that is built into the financial intermediaries' systems for relating to their clients. Because if you don't do that, you won't achieve any systemic change. So one of the things we've done is to say to any of the financial intermediaries we're investing in, you have to collect this data across your portfolio. It's not a question of just telling us what our money does. You know, we invest $1 million and you tell us what happens around our $1 million. You actually have begun to have to tell us what you do about your whole portfolio, which is an interesting challenge, which our first two investees have thankfully committed to. So here's the first investment. Not a typical Oxfam country. We actually don't have an Oxfam program in Mongolia. Now, I'm told that Oxfam Hong Kong once did have one. But Haas Leasing is an offshoot of Haas Bank. Haas Bank is a microfinance bank that was founded by Mercy Corps International, a US-based NGO, and it provides leasing to small enterprises in Mongolia. Mongolia is a fascinating country. It's one of the 67 that I have visited, indeed have visited Haas. And Mongolia is sort of in the middle bottom region of on the Human Development Index. It is certainly an emerging economy. It is about, in 2014, to double its GDP in 1 year, because Rio Tinto are opening a copper and zinc mine, which is of sufficient size to double Mongolia's GDP in 1 year. Now, that might be both a blessing or it might actually be a curse. We've all heard about the resource curse, and it will certainly generate a degree of at least very significant potential for significant inequalities in Mongolia. But it does also present all sorts of interesting opportunities for small entrepreneurs, And the government, more or less, is committed to trying to find ways in which the benefits will flow across the economy. But HASS is well known in the microfinance space for delivering against both its economic but also its social and indeed environmental criteria. So here's a target. Here's a fund which is actually based in West Africa, Francophone West Africa. And again, this is a fund that invests into the agricultural value chain. One of the concerns, certainly of Oxfam, has been how do you build infrastructure that exists between small-scale farmers and markets? And this fund has looked at and is exploring various ways of investing into that space in order to extend the opportunities that small-scale farmers have for market access. And we don't underestimate how difficult it is for investees to measure impact. So alongside the fund, there is something called the Impact Support Facility that's going to provide technical assistance to the investees around the measurement and fulfillment of impact, and how do they integrate that ability to measure impact and to focus on it from an investment point of view into their daily workings as an organization. So what does that mean in terms of systems? What does that mean in terms of data collection? What does that mean in terms of the client's relationship to the investment institution and to the credit officer? So sometimes when people talk about impact investing, I think we're in the process of inventing impact banking, or indeed, as someone said to me the other day, aren't you just reinventing old-fashioned banking? Circa, well, choose your decade, 1920 or something. But, and this is really exciting. It might sound a bit nerdy, but I walked into the International Finance Corporation in July, which is the investment arm of the World Bank. And the IFC has just been given £100 million of most people in this room's money, I expect, if they're taxpayers, from the Department for International Development. The Department for International Development tends to hand out cheques of £100 million because it's quite difficult to spend all their budget in one go. Anyway, and they've you know, it's about the third chunk of 100 million they've given. Anyway, so they've given it for a small enterprise banking facility fund, which is meant to grow to about £1 billion over the next 5 years. So I walked into the IFC, and I walked into the IFC, of course, since I'm launching a fund with my investor bold at the ready, only to discover that DFID had told them that for the first time ever, the International Finance Corporation would have to measure outcomes to their investment around employment generation. And they had never done that before. So they were, and it was really a fascinating conversation because they sort of, how do you do that? You know, and we said, well, haven't you talked to GIN? Who are GIN? They said, well, you know, well, they're in Washington and GIN is in New York. And we said, well, haven't you heard of IRIS, which is run by a group called the Aspen Network for Development Entrepreneurs on behalf of GIN? No, they said. But Andy is just down the road. And we can get out of the office at the IFC and walk down the road in Washington, and there you are in the Andy offices. So you can see how institutions find it somewhat difficult to learn about anything outside themselves, which is true, I think, of large institutions in general. But from an Oxfam point of view, this is really exciting because it's not just, in our case, about having a fund, which hopefully works. It's also about how do you change the space in which you're operating in. So how do you persuade other investors who have lots more money than we're ever likely to have in our fund, even if it's spectacularly successful, to actually change the way they do things? So if we've got the IFC, and we are now in this interesting conversation with them around how they do impact positive outcome measurement, we will have achieved as much, I think, or indeed more, working with them than we might actually succeed with through our fund. So this is probably all terribly dull, but the fund is a SEIIF in Luxembourg. That caused a very interesting conversation in Oxfam, I can tell you. And why? Well, actually interesting, Luxembourg has decided that it ought to be the European capital of social investment. So if you look at the global social investment fund structure proportion, Luxembourg has about 3/4 of it, which also created a very interesting conversation at the City of London Corporation, because they wanted to know why London isn't the capital of social investment. And the answer is, it would have taken us 4 times as long and twice as expensive to actually register in London than it would have in Luxembourg. And we, as Oxfam, are the impact advisor, so that's our role. Our role is to think about impact. And every potential investment goes through a 2-filter process. So there's the impact filter first. So are the investees committed to, demonstrably committed to, achieving social and developmental impact through their lending or investment? And then we look at the finances. We sit on the investment committee as Oxfam, as does Symbiotics, the fund manager, and then we have 3 independents, and so on and so forth. Oh yes, there's the governance, and there's the investment committee. An interesting group of people we collected. Aureus is fascinating. Aureus was a spin-off from CDC, which is the government's development investment group, and works very successfully in this space, so just above ours. So most of their investments are in enterprises which employ between 200 and 1,000 people, but have some very strong social criteria around that. Gavin, who currently runs Scottish Widows, and Stephen, who's at Standard Life. Oh, and there's contacts. And I think that's probably, a disclaimer. Probably telling you, you didn't watch that, no. Telling you that I probably should have told you something about, in order not to be arrested by somebody. The Financial Services Authority, or perhaps the New Bank of England. So that's basically what we're trying to do. We're trying to build an infrastructure which invests in this space, which enables these institutions to invest against rigorous impact criteria, and invite people into this space who haven't perhaps been there before. So if you look at social investment, there's lots of reports about how impact investing is going to be worth X billion dollars by 2015. Yet for the last 3 or 4 years, if you go around this space, you just find yourself talking to exactly the same people. I was in America in June, and you're talking to Gates and Rockefeller and somebody else, And so we wanted to try and develop a product because of its diversity, because of its global reach, because of its debt focus, so it's not very volatile, in which other people could invest who haven't been in this space. And I'm pleased to report that early signs is actually true. We've had foundations who've never done a program-related investment or a social investment before invest out of their endowment, not out of their grant funding. We've had private net worth, high net worth individuals who've never, their investment managers have never invested in this space, who have done so. So it's a very interesting, not that we're trying to turn away any of the usual suspects, of course, but we wanted to extend that boundaries.
Thank you, Nicholas.